VICI Properties offers a yield of nearly 6% and it had a dividend increase just last month of 6.3%. This REIT is undervalued severely in my opinion, and I'm going to discuss today why you need to be adding this at a minimum to your watch list, if not into your portfolio. Today's episode, we're going to look at the things we look at on every episode, but today we are going to jump into their investor presentation that only dropped a few weeks ago, and we're going to pay some particular attention to why I love VICI Properties and why I believe you need this one in your portfolio. We're going to take a look at a lot of information, a lot of positive reaffirmation as to why this is an incredible REIT. As always, we will take a look at the historical performance of VICI Properties. We will, in fact, jump into their income statements, look how well they have performed over the last 5 years on the bottom line as well as the top line. We will jump and look at the health check of their balance sheet, taking a look at their total cash versus their total debt over the last 5 years. And as always, we are going to understand the dividend safety score and take a look at some very important financial metrics that you need to understand before becoming an investor in VICI Properties. And as always, we will run it through our stock valuation model, getting to our intrinsic value and our acceptable buy price given our margin of safety. Now, it is down 12% year to date, and it's right there at that 52-week low with a yield forward looking of nearly 6%. And today we want to understand, if we lock in prices we see right now in the market, can we expect to see double, triple, even quadruple the current share price over the next few years? And with that yield, can we expect to see our yield on cost grow to double digits? Now, I'm going to run through a few of the reasons why I love this company, and we're going to take a look at their investor presentation, which was only released a few weeks ago. Now, the first thing to note, they have 100% triple net leases, and what this essentially means, all the costs in terms of expenses, upkeeps of their properties, their maintenance, is all essentially with the tenants themselves. The tenants themselves, we can see their names listed here. They have 11 tenants, of which some of them have more than one property. So let's take a look at their first tenant, their largest, in fact, Caesars Entertainment, of which they have 18 properties, and around 40% of VICI's total rent year on year comes from Caesars. Now, this column is very important. What you see here, the second column on screen, essentially the weighted average of the lease term. So what this means is that Caesars, although they have 18 properties, on average, these properties are responsible by the company for the next 32 years. Now, what makes that even more interesting is that the average across all 11 tenants is around 42 years. So if you're thinking, okay, that's a very long time, well, realistically, unless you're someone who believes these industries, the entertainment industry, the travel and hospitality industry, are going to go completely off the earth, wiped out, then this is something that is here for the long term. So as I mentioned, Caesars 32 years. We'll look at the number of properties they have and those particular. And then you have MGM Resorts, the Venetian, quite a lot of popular resorts for those that know Las Vegas or have been, we'll see. And as we can see, around 76% of their annualized cash is just made up by Caesars and MGM. So in terms of what else is it that we like from here, well, let me point you to this firstly. In the last few years, in fact, the last 5 years, VICI have had 100% rent collected, which is very positive. And as we can see here, the average for the industry is around 70 to 99. Now, another thing that's incredibly positive is here, 96% of their rent is protected by a long-term CPI. So if the CPI goes up year on year, so will their rent. Now, that is very positive. Again, if you're comparing it to the sector, 16 to 85%. Now, in terms of putting a number to that, the same store rent growth, 1.9% year on year. Again, 0.4% is what the average has been. Now, in terms of looking at the CPI, as we can see here, this is essentially showing us that as CPI increases, so will their rent over time, which is very positive, especially if CPI goes up significantly higher than has been over the last few years. Now, in terms of their properties and where they base locationally, well, straight away, 47% of them are in Las Vegas. And again, we can take a look at those properties. 1% international with 52% in the region. So a few, just for those that don't know, well, you have MGM Resorts, and you have Caesar's Palace. But essentially what they're trying to show here is that they are essentially diversified not only just by the sector, but also by location. Now, in terms of having a look at their multiple revenue streams, well, what can we see? Well, 54 properties in terms of where they're based, in terms of Las Vegas and the Canada region. We can see the companies, again, MGM, the Venetian, Caesar's Palace, hotel rooms, gaming spaces, meeting conventions, food and beverage outlets, retail outlets. So there's quite a wide variety. It's not just all Las Vegas for those who are new to VICI Properties, and that's all they've heard. Now, in terms of moving down to when we can take a look at their actual performance, we can see here. So year on year, they've had a 7.6% compounded annual growth rate on the cash dividend per share. And on top of that, what we can see is they are targeting a 75% AFFO payout, which we will touch upon shortly. And again, 100% cash collected, just to drive that home, since their formation in 2017. So a question you need to ask if you are looking to invest into VICI is, do you see this industry or these industries that we've touched upon being here over the next 20, 30 years and beyond? So there is some more information here in the investor presentation, and I can drop a link in the comments for those that want to take a deeper look. But this was just something I wanted to touch upon before jumping into the stock itself. So as we can see, around the 52-week low currently with a yield of around 6%. So how has the company performed in terms of their income statement year on year? Well, typically what we like to see is 5 to 7% growth for REITs in general. So top line December 2018, around 900 million in terms of revenues. December 2022, their latest annual report, around 2.6 to 2.7 billion. So there has been some nice growth over that period. Again, on a more granular level, you can see essentially the top line flat from 2018 to 19. But even from 2019 onwards, even when we had the COVID year, the lockdowns, we can see they still managed to generate some nice growth on the top line. And that has continued onwards year on year, and some very strong growth from 2021 to 2022, increasing their top line by around 1.1 billion. Very positive to see. We'll touch upon the last 10 years in terms of percentage wise soon. But in terms of their bottom line, how has that performed? Well, 524 million in 2018. Latest annual report, 1.1 billion. So nearly essentially double their bottom line over the last 5 years. Again, very positive to see increases year on year. So far, very positive in terms of their financial statements. In terms of the balance sheet, a quick health check. Well, cash versus total debt. 2018, around 580 million in terms of cash. Latest quarterly report, they're holding a little bit more, around 740 million. And how does that compare to their total debt? Well, total debt around 4 billion in 2018. Latest quarterly report, in fact, showing their total debt has gone up around 4 times as much, which is very significant, especially when it far outweighs the increase in cash. So this is something we need to take a look at when we look at our supporting financial metrics for VICI Properties. Straight away, dividend safety 50, making it borderline safe, so we'll take a deeper look into that. Market cap around 28 billion, making it a large cap company. Now, typically what we do here is we look at the recession data to compare it to see how it performed in the previous recession in terms of their dividend, the sales and the return. But given this was formed 2017, we are unable to use that metrics and data. So let's move on and look at their dividend growth. So last 4 years, as we can see, they have been increasing the dividend. Latest increase only a few weeks ago at 6.4%. Very positive to see, as I always say, especially for investors that are new to the channel. You want to be aiming for an increase of 4% in your dividends, your other income producing assets, and essentially your salary, due to the fact that the average US inflation rate over the last 40 years was 4%. Anything less, you are in fact taking a pay cut and losing your purchasing power. So very positive to see above inflation, especially with that yield nearing 6%. And on top of that, as we saw in the investor presentation, the dividends have increased compounded annually by around 7.6%. So very positive to see so far. Now, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. And what we can see here, 5.92 versus 5.03. So we have our first sign of undervaluation. However, as always, we never look at any model in isolation and will draw our conclusions towards the end of the episode. Likewise, another sign of undervaluation, the forward P to AFFO below the 5-year average, 12.9 versus 14.8. And we can see the sector P to AFFO roughly in line with that of VICI's at 12.9 versus 12.4. And as I mentioned, it is at the 52-week low, but do bear in mind 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Now, as we saw in the investor presentation, they are looking to keep that AFFO payout around 75%, which is roughly where it has been over the last 5 years. Now, typically for those investors that are new to the channel, what we'd have here would be the earnings payout versus the free cash flow, but I would always tend to ignore any earnings data purely because earnings are susceptible to manipulation by management through their accounting. But for REITs, we tend to ignore the free cash flow payout just due to the fact of the volatility. Reasons for volatility in REITs are things such as upfront rent payments, maintenance expenses, and deferred financing costs. So far, adjusted funds from operations looks positive to see, gives me comfort in that dividend safety. Adjusted funds from operation per share, again positive to see the increases year on year over the last few years. 37 cents in 2017, 193 in 2022, with 2023 expected to be 218. So positive to see so far on the metrics we've discussed. Now, sales growth, again, 5 to 10% is what we like to see year on year, and we can see some astronomical growth in 2017 to 18. No real growth in 2019 as we discussed, and then 2020 to 2022 we again see some strong double-digit growth. So this is a company that is continually growing, which is very positive to see. 2017 on the top line 200 million, 2022 more than 10 times growth at 2.66 billion. So far so good in terms of the metrics. Now, one area that I tend to not really find positive with REITs, but is very common, is we see shares outstanding increasing. Typically, we love it when companies do share buybacks, returning excess cash to shareholders' pockets. But with REITs, we see the complete opposite. The reason for this is the majority of their generated cash flow is paid out as dividends, as we saw with the AFFO ratio around 75%. And therefore, the way for them to generate additional income or, additional funds to essentially fund their growth projects is to issue shares and therefore dilute yourself as a shareholder. 2017, 228 shares outstanding, 2022, 880. So in my opinion, this is raising those shares at quite a fast rate. It isn't something that's positive, but again, bear in mind, this is what comes along with investing in REITs. Now, typically ROIC, what I like to see is 10% plus, as essentially it means management are effectively allocating that capital. It is in fact one of my 7 golden dividend metrics. Do check the pinned YouTube video if you want to see the other 6. However, with REITs, the typical percentage we tend to find is 3 to 5%. So very positive to see for the majority of the period. It has been between that, if not higher, 8% in 2021, 5% in 2022. So moving forward, I would like it to move back up to the 8% and higher would be a lot more positive for the company. Operating margin, slightly inconsistent, but is well above what we would like. So very positive to see. 95% in 2021, 63% in 2022. So it would be positive to see this percentage go up higher to what we've consistently seen, 70% plus over the next few years. And again, the higher that operating margin, the higher that bottom line net income will be. And this will then affect that dividend that is paid as well as the dividend increases year on year. Finally, the most important metric, which is the one that I flagged when we were looking at the balance sheet with that increase in total debt by 4 times. The net debt to earnings for interest, tax, depreciation, and amortization. 3.5 is the maximum we look for hotel REITs. 3.5 signaling the number of years it would take the company to pay off all their debt net of cash on hand. Now, for the large part, it hasn't even been below that bar 2021. 2022, it's at 6.46, which is considerably higher than what we like to see. The positive is that in 2023, it is expected to come down to 5.66. But again, bear in mind, this will have an impact, as we can see, on that dividend safety score and those dividend increases. So it would be positive to see this continually come down to around 3.5, as that would help gain faith in that dividend safety. And on the right, we see the net debt to capital, essentially showing us the percentage of a company's financing from debt as opposed to equity. Now, as always, if you have been enjoying the content, value is being provided. Smash that like button, hit that subscribe and bell button if you want to be continually notified of these videos as they drop onto your doorstep. And if you want to run this valuation model through your own companies in your portfolio to get your own intrinsic value and acceptable buy price, do click on the pinned description below to grab a copy. So typically we'd start off with Graham's valuation model. However, do note for REITs, this isn't an appropriate metric and therefore won't be used in our intrinsic value calculation. However, for those that are new to the channel and want to understand how we use this, we essentially get our stock ticker, we get the earnings per share, growth rate per analyst estimates, alongside that current yield on AAA corporate bonds. This essentially gives an intrinsic value, which we see here at $29. However, again, given it's not appropriate for REITs, will not be included. Therefore, we jump into the first model that we're using today for valuation purposes, REIT multiples valuation model. We've got companies in a similar sector and size, SBA Communications, Digital Realty Trust, and Extra Space Storage. We have their stock price, P to AFFO multiple, of which we get the average. Divide that by the P to AFFO of VICI, times by the current price to get a stock price based on the REITs multiples valuation model of $34.50. As we can see, some nice upside to the current trading price, but within that 52-week range. And don't forget, if you do lock in these prices and the prices increase, then your yield on cost with that will also go higher into the double digits, which is what we'd love to see. As always, though, we never look at any of these models in isolation and we'll draw our conclusions towards the end of the episode. We then have the second model where we have the yearly dividends for VICI. As we can see, some very strong growth rate, currently around 9%. Forward looking now, you could argue much higher than 4%. However, given the macroeconomic conditions, you could argue alongside that total debt, which seems to increase, that it may suppress the growth rate that we have typically seen from VICI over the last few years. So I have it here in line with inflation at 4%, which isn't bad if you are locking in a yield of around 6%. As always, though, if you want to justify a higher or lower percentage, grab a copy of the model as per the pinned comment below and put your own figures in to get your own DDM price or other prices. So this gives a DDM price of $44, again above the 52-week high, showing some significant upside to that current trading price and showing signs of undervaluation in the current model. We then move on to the third and final model, the discounted cash flow model, where we have the free cash flows year on year for VICI Properties. As we can see, the average growth rate is coming to around 95%, which is very, very high. Forward looking, we've gone for around 8% in conjunction with that discount rate. We get the present value of future free cash flows and terminal value, add the cash and cash equivalents, subtract total debt to get to our equity value. Divide that by the shares outstanding, we get a DCF price of $38. As we can see, that's higher than the 52-week high, showing significant, again, undervaluation to the current trading price. And again, you are locking in this 6% yield. So if the price does continue to go up, your yield on cost will also go higher and higher. Now, in terms of the essential intrinsic value, well, the intrinsic value is the average of the three models we have just run through. And as always, it really helps the channel. If you've enjoyed the video, smash the like button. It helps increase our community. And as always, if you do want to grab a copy to get your own intrinsic value, whether it's for VICI or other companies in your portfolio, do grab a copy in the pinned description below. So we have the current intrinsic value at $38.66 with the current trading price at around $28. What I typically would say, margin of safety of 10% if it has a wide moat, strong financial metrics, good forward-looking data. Now with VICI Properties, you could argue you're looking for a higher margin of safety. So if you're looking for 20%, your acceptable buy would be up to $31. If you were looking for 30%, your acceptable buy would be around $27. Now, personally, I was looking for a margin of safety around 25%, and I personally have been adding VICI not only to my portfolio as I already have shares, but just accumulating more shares of VICI Properties, which I do see over the long term being an incredibly positive company to have in the portfolio. As always, though, Wall Street, what do they forecast? Well, they're looking around $37, so not too far off our intrinsic value over the next 12 months. So they do see some strong upside to the current trading price. As always, let me know your thoughts in the comments below. Are you looking to add VICI Properties to your portfolio? Are you looking to sell, or purely on the sideline speculating? If you've enjoyed today's episode, do hit that like button. In fact, smash the like button. Press the bell button and subscribe button if you haven't already and want to join this lovely community. And as always, click on the pinned comment below if you want to grab a copy of the valuation model. And as always, have a great day, take care, and catch you on the next episode.